Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I trust you've had a good weekend. We're back into the full swing of things with trading this week. We've just had some data out in Australia where we saw the inflation, Melbourne Institute inflation gauge, see further inflation on a monthly basis, up 0.2%, but it was up 1% the month before. It's slowing, but don't get too excited about that because that economic data series is quite chaotic. And I don't think it's ever really added any value to the debate on which way inflation is going. It tends to confirm inflation trends we're already aware of, but not necessarily indicating where inflation is going. We do know that around the world, inflation is slowing, so we should expect that to occur in Australia as well, but maybe not as quickly here as it is doing elsewhere. We haven't gone quite to the lofty levels of some other Western economies, so we're a little bit more dampened in terms of that slowing process. I don't think that number is going to have anything to do with what the RBA will be doing. And the RBA will be raising rates still by 25 points per meeting until it's sure it's got inflation under control, because it's got a terrible track record at understanding anything economic or adjusting monetary policy at all well. So if it can have a win on this occasion, it's not going to risk blowing that by stopping too soon. So 25-point rate hikes from the RBA going forward for the time being. Remember, those rate hikes by the RBA are still a negative for the Australian dollar, as any 25-point hike by the RBA is really just a punctuation point to the fact that the Federal Reserve will continue to hike at a faster rate. Therefore, the yield gap between the Australian and US dollar continues to grow. In fact, it doesn't have to keep growing. It's such a huge yield gap already at this point that it will be a continuing downward pressure on the Australian dollar. We've seen the US dollar weakening recently across the board, and I do think that could be coming to an end soon. I started saying that last week, and I do think the Australian dollar could be among the more vulnerable currencies against the US dollar, as despite the opening up in China, the outlook is still for a rather lackluster movement forward there in terms of the Chinese economy overall. There'll be a little bit of spirited economic data as China comes out of the lockdowns, but the overall trend will be much lower than has been the case in modern history. In China today, we also saw some housing data there where prices continued to fall for the 8th month. They're down 1.6, 1.5% on the year. They're not big falls, nothing like in Australia. In Australia, I think we've fallen about 8% in the average home price over the last 10 months or so. So Australian property prices, as expected, falling significantly and still falling. So China's problem isn't at all like Australia's, so we shouldn't get too panicked by it. We saw China's housing prices, 70 major cities index, falling in 2015 as well, and then the market stabilized. Situation is a little bit different now, a little bit more problematic, but I still think housing prices in China are going to remain soft, but by no means any kind of crisis-inducing scenario there. Whereas in Australia, we are headed for considerable mortgage stress over the next 12 to 24 months, as more people belatedly shift from floating to fixed interest rates, on their mortgages, and a lot of people are going to have trouble struggling with that. And I think, and I really have been saying this for a couple of years now, that 2020 was a boom year for property, people buying frenzies, that 2020, 2021, that 2022 would be a flat year in terms of sales, that we would flatten off in terms of the sales of properties, the level of activity. And then in 2023, I'm expecting 23, 24, that the housing or real estate industry will get quite busy again, but this time it could be forced sales, but there will be a lot of product. At the moment, not a lot of product, not a lot of buyers on the Australian property scene. It's different state by state, even suburb by suburb, but overall housing prices continue to fall in Australia, and that looks to be an entrenched trend for the moment. On the housing front, we had dwellings data come out in Australia today, and that was down a whopping 9% on the month. That's dwelling permits approvals, down 9% on the month. That's down about 23%, 24% over the last 3 months. So developers are just starting to become very scarce on the ground in terms of further work. For units, it was actually down around 22% in just the 1 month. So that whole property development area of just building these skyscrapers of units and finding buyers wherever they can, that seems to really have come to an end now. And a lot of people who bought off the plan are probably not going to follow through with their purchase. So we're going to see continued pressure on developers. Australia's already seen many property developers go to the wall in the last 12 months, and that could intensify moving forward as Australia enters a recession overall. So the outlook then for the Australian dollar, with both that domestic and external backdrop, the Western economies headed for recession this year, at least a very sustained slow economic period, lack of global growth, a domestic economy with mortgage stress, it's not a good outlook for investing in the Australian dollar with a yield interest rate differential to the US dollar. I'd just be very careful about this Australian dollar rally, that it is getting towards the end of its life here. The Australian stock market looks like everyone is bought, just waiting for the US market to go up yet again tonight. I think there's a chance the US market could rally in the morning session. I'm starting to get a little bit concerned about the afternoon session in New York. If not this afternoon, Monday afternoon, Wall Street, perhaps Tuesday. And remember, I did forecast that there could well be a rally into the US inflation number, but then within 1 to 3 days after that number, we could well see a top in US equities. And there's nothing really forcing me to change that view at this point. Yes, the market is moving higher, but it's not exactly unexpected. And the market is tiring, it's getting weaker. The market's really struggled to make a marginal new high on an intraday basis in New York on Friday. The follow through we're going to see today, Monday, is probably about as much follow through on that data release, that 6.5% inflation number that we're going to see. And so once that's into the wash, I think you're going to have a world that's very, very long with potential to the downside. And if the price action starts to turn down on top of what is already a dire fundamental economic outlook, that's a pretty powerful combination. So at the moment, those two forces are a little bit opposed. The technical price action is clearly bullish. The fundamentals are clearly bearish. But as we get towards this euphoric peak of people mistakenly thinking that inflation is no longer a problem and the Fed can stop raising interest rates, which is just a whole lot of rubbish. Once everyone who wants to buy on that rubbish has done so, the market's going to be very vulnerable to the downside indeed. So I'm seeing a very cautious week ahead for equities, mixed for the US dollar. I still like gold. Oil has been problematic. The global economy is slowing, but there's going to be more sanctions applied to Russian supply. Very difficult basket of factors to figure out there. I'm a little bit cautious on oil. Maybe if I had to be anything, I'd probably be bullish, but I'm certainly for the moment bullish gold. It looks like it could be accelerating. Australian dollar, as I said, I'd prefer to be a seller here, even if I'm going to get it a little bit wrong on the day, and the same is true of Australian equities. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.